Hey guys, welcome to your quick market update. Today is Friday, July 11th. Rates got hit today with a hotter than expected inflation reading out of France. And because the globe and yields are interconnected, it causes yields everywhere to rise in sympathy. But the bigger news this week was the minutes from the Fed meeting that happened a few weeks ago. The idea of a rate cut in July sounds like it's gone and has now been moved to September. Fed Chair Jerome Powell has come under a lot of criticism for not cutting rates, especially because he cut rates last year in September, November, and December by 1% in total, when inflation was slightly higher and the labor market was even stronger than now. Powell has been claiming to be data dependent, looking at hard data that is backward looking. This has caused so many issues, you guys, in the past. Like when inflation started to rise and he thought that it would be transitory, even though there was $5 trillion put into the economy and the Fed had rates at zero while buying a ton of mortgage-backed securities and treasuries through quantitative easing. As a result, what happened? Inflation got out of control. And I've talked about this before. It rose to the highest levels we have seen in over 40 years, and we are still dealing with that impact. Now suddenly, Paul wants to be forward-looking. He is worried about the potential impact from tariffs on inflation, even though it has not shown up yet. Tariffs are also different than inflation, and I've talked about this as well, because it's a one-time price increase and not persistent and ongoing like inflation. I would be in favor of the Fed looking forward, but Powell appears to be cherry-picking which data points he looks at. Inflation has been tame, and the labor market is showing clear signs of weakness in pretty much every report except for the dreaded BLS jobs report. And you guys know how I feel about that. Unreliable, and the revisions that occur there are ridiculous. Perhaps the biggest reason why the Fed should cut, besides trying to stave off a slowdown in the labor market that is apparent, is that the Fed is restricted by roughly 1%. They could cut rates by a quarter and still be restrictive by 0.75%. Someone who appears to get this and is one of the top candidates for the next Fed chair is Fed Governor Christopher Waller, who I love. Waller spoke yesterday and doubled down on a July 30 rate cut. Previously, Waller voiced his reasons for wanting to cut rates later this month, but that was before the stronger than expected jobs report. Yesterday, he said that the Fed should still cut rates, even after the strong June jobs report. His reasoning: inflation has come down far enough to justify a move, and tariffs should not be a reason to delay. He also explained that the Fed is currently too restrictive. Next week, we are going to get the consumer price index and the producer price index, and these are both very, very important inflation indicators. These reports last month may still not have included some of the impact of tariffs, so I think a lot of people are going to have eyes on these reports, and they could be potential market movers. So until then, thanks for watching, and have a great weekend.